Morning, everyone. I'm just going to give you a brief summary of the commercial investment market, and then Paul is going to touch on the residential sector. So I'm going to provide an overview of activity in recent years, and then just have a quick look at the different asset classes and the occupier market. So the first slide shows us a summary of investment by volume from 2009, and I think it's pretty clear, sorry if I'm standing in the way, I think it's pretty clear the upward trend we've seen since that point, which peaked in 2014 at a figure of just over £70 billion. There was a slight reduction of 5% in 2015 to 67.5 billion, but that is still the second strongest year on record and 46% above the 10-year average. There are not too many graphs, by the way, but a couple just to set the scene. When we look at the investment activity by sector, it's pretty clear that the office market, with 44% share, is by far the dominant force, with the retail sector and the industrial sectors lagging a little behind. That having been said, in spite of slightly weakened activity in 2015 again compared to 2014, both of these sectors are still enjoying strong performance against the 10-year average. If we now look at investment by region, excuse me, the dominance of London and the South East is absolutely clear for everyone to see. London accounts for 56% of all investment in the British Isles, and when you combine London and the South East, that takes up two-thirds of all investment activity in the UK. And again, while levels fell in 2015 across most regions in the UK, those figures were still in excess of the 10-year average. In terms of asset performance, obviously you all come from a range of backgrounds, so forgive me if I'm sort of talking through the very basics, but the indicator for commercial offices is, particularly the investment market, is the yields that people are prepared to accept based on the prices that they pay. And this graph indicates how those yields have shifted from 2008 through to 2015, and it compares the London market with all activity outside of London. The key point I would draw your attention to is where London starts at 6% in 2008 and drops down to just above 4% in 2015, and that is really an indicator of obviously increased pricing in London, and you see the gap between the blue line and the orange line, the difference in pricing between London and other areas outside of the UK. Outside of London. In terms of average yields across the individual asset classes in 2015, the average office yield was 6.75%, industrial at 7.3%, and retail at 6.63%. Having a quick look at offices now and the current trends we're seeing in the office, in the occupational side of the market and office use, clearly the way that people are using their offices is changing very quickly. And there was a point, I think, recently where people thought that the requirement for office space was reducing with a trend of a workforce that worked mostly from home. And I think we're pretty comfortable that that's not the case. I think space requirements have reduced as companies have refined flexible working policies that's enabled by much better technology to sort of video conference and stay in touch with their teams. But it's absolutely clear to us that the need for physical space for your company to get together for face-to-face meetings is absolutely critical for teamwork and morale. On top of that, the race for talent is a crucial challenge for all of our clients and all companies out there, and your property does form a crucial part of your corporate brand and needs to create the right image for staff and for customers. The other, as well as the conventional side of the office market, one key point that we would draw your attention to is the rise of serviced office space and of co-working space, which is co-working particularly a new phenomenon whereby you simply pay a monthly subscription to use an office, and you can sort of renew that and take on as many desks and flex as much as you need to. And I think that is it's a very interesting phenomenon whereby companies are able to take a much greater level of control over their overheads, and can flex their space accordingly. In terms of the occupational markets, we've seen strong rental growth across the southeast in recent years, especially in London, but also in Crossrail hubs such as Slough, Maidenhead and Reading. At the same time, it's clear that companies are still quite cautious about committing to expensive relocations, particularly the capital expenditure related to fit out, and also the obvious disruption. And we're seeing that companies are often choosing instead to invest in their existing space to improve efficiency and productivity. In terms of what companies are looking for, we would say excellent access to public transport, good local amenities, and good car parking ratios, particularly in this area, are some of the key criteria. In terms of the industrial sector, e-commerce is having a significant impact on the industrial landscape. We've all seen the multitude of courier vans and Ocado vans racing around the roads where we live, delivering online purchases and groceries. And logistics companies are having to adapt the way they behave from taking central hubs to now having sort of multiple hubs. We will also with and adopting a hub and spoke strategy whereby they have multiple areas around those hubs to manage the requirements of their logistics needs. In the southeast, particularly, and in this area, we see logistics companies competing for space alongside the perhaps more traditional users in this area in the form of the airports, the F1 racing and the satellite users. From a occupier's perspective and in terms of market performance, available space for all industrial space is down at around 7%, which indicates an extremely tight market. Obviously, supply is constrained by the opportunities for developers to create new industrial sites, but it's unsurprising that restricted supply means that the rents are likely to increase in the foreseeable future. As with offices, obviously the access to good local transport networks is crucial, along with access to the airport hubs that we have nearby. Oh, sorry, I was on retail. So on retail, the key trend that we've seen in retail over the last couple of years is the multi-channel approach to people purchasing goods. So in 2015, we noted a 21% increase in sales online, which now takes up to 40% of total sales for retailers. Sales from smartphones and tablets were up 31%, click and collect sales were up 16%. So the need to have your retailing business online is absolutely crucial, and all retailers are trying to have secure a good base for that. But at the same time, we're seeing online retailers trying to establish a bricks and mortar presence on the high street, which is a crucial part of the developing brand, but also a useful distribution channel. In terms of the high street, we see retailers focusing very clearly on prime locations and where the footfall is highest, and that's creating a bit of a problem in terms of secondary retail locations where we're seeing a lot more vacancy. And landlords are increasingly having to look at pop-up shops as temporary solutions in order to manage the risk and cost of holding those vacant units. Out of town, Retailers such as Costco, Next and John Lewis, real destination stores, continue to prosper. But in the face of, at the same time, the face of convenience stores is changing, as consumers are tending much more towards a big online weekly shop and then dropping into a convenience store to pick up a pint of milk or a loaf of bread as and when they need it, rather than relying on the big supermarkets week in, week out. So what next? So over recent years, the London market has been strong with an influx of capital of foreign investors. Thank you, Paul. With an influx of foreign investors, mainly from mainly from Asia, as demand from the Middle East and Russia has cooled, along with the price of oil. Though I think those foreign investors focus mainly on London and the Thames Valley. However, as pricing for investments in London has become too hot for some, we're seeing more London-based investors scouring the Thames Valley for better value for money, which is a trend that we see continuing. We also see that those foreign investors will continue to focus on London-based investments because of the prestige associated with London. There is other trends that we see continuing is the trend for investors looking to maximise site value by converting office or commercial space to residential, and also for investors to purchase property through pension funds in order to benefit from the rising capital values and at the same time paying themselves a rent. There is a suggestion that the capital and occupational markets have taken a bit of a breather pending the referendum in June, as we've discussed before. And we're certainly seeing signs of that in terms of our day-to-day business. But in our experience, there will always be economic uncertainties, and certainly in a global context, the UK and the South East remains a good and safe place to do business.